MiFID II has been in place exactly 100 days. The vast set of rules that was meant to impose unprecedented transparency on traders and seek to curb conflicts of interest has had some effect. Hasn't generated that much market volatility, which is interesting. What impact has it had? Let us find out. Ben Pott, Head of Government Affairs at the Next Group, joins us now on set. Good morning. Has there been... people were worried that we were going to see kind of huge market turbulence as a result of that. I've struggled to see it. Is it there?
I don't think it has really happened. I think overall the MiFID II implementation really has been as smooth as it could have been. We haven't really seen any major market disruption. We haven't really seen any impact on liquidity. In fact, more of the opposite. Trading volumes really have been very healthy in the first quarter. Saying all that, ultimately any rules, any regulations doesn't get judged on how much disruption it causes, but more whether it achieves the policy objectives. And I think on that side, the picture has been a lot more mixed.
Okay. A little more detail on that, if you will.
I think in particular around the transparency side, right? We always expected MiFID II to really drive our transparency, to replicate what we've seen on the equity side so that investors can see price formation in derivative markets, for example. Now, one of the key challenges here has been that when you look at the derivative, the information can be published in multiple different ways. You have a trading venue, they publish their own information. If you trade bilaterally, you'll use what's called an approved publication arrangement, and there are many of them who all publish information. So you have loads of different sources where you can obtain that information. And actually, there's been surprisingly little guidance around how you make that information available. So we've seen lots of different formats, how that information is coming out. We've seen different approaches to how long that information is available, a few minutes here, a few hours there, until the end of the day. So it's very difficult from an investor perspective to get hold of all the different sources of information, to make sense of it, to aggregate it. So I think that's a key challenge that needs to be addressed.
But in general, Ben, it seems that you have a positive, or at least not a negative, look at how we're doing 100 days in. My question would be on the company side, on the cost side. How much has this cost? How much is this hitting bottom lines of those putting these regulations into effect?
It's clearly been incredibly costly just leading up to implementation. And I think it's fair to say that we haven't really reached the end of that yet. Take the example of reporting, for example. Every day, as a company, you have to transaction report a huge number of fields to the National Competent Authority. That information is very detailed. It means you have to transmit, for example, information relating to the trader, that his ID details, his date of birth, and that information has to be submitted not just to the regulators, that also has to go to the trading venues, and that information has to be resubmitted on a daily basis. So the cost impact has been absolutely significant and will continue to do so, and it causes concerns for all involved. I would make the point, though, we often focus on the cost imposed on the market participants. Actually, there's been quite a significant cost imposed on the regulators as well. They had to get systems ready to absorb all that information, to take in these reports, to make sense of them, to validate whether it's the kind of information they've requested, to send acknowledgements back to the firms. So that's a kind of ongoing process, right. And that also imposed a lot of costs on the authorities. So it wasn't a kind of one-way street when it comes to costs.
So final question. We've had a fairly soft implementation phase. The regulator's been fairly sort of easy on everybody. What next?
I think there are a number of different areas. First of all, regulators clearly are looking whether they need to take enforcement action in some areas. But we also need to bear in mind that actually implementation isn't over yet. There are a couple of different rollout of waves still to come. If you think about the dealer-to-client business, having to effectively license yourself as a systematic internalizer, that all goes live in September. And then we have another rollout of liquidity reassessment. So that's all still to come. And I think until that all beds in, I think regulators will be hard-pressed to take any enforcement actions. And the one point I want to make is, actually, we focus a lot on MiFID II in terms of the impact of regulation on the market.
Yep.
But there's another wave coming. If you think about the SFTR, Securities Financing Transactions Regulation, that's coming in 2019. So, MiFID II was a big hump to get over, but there's more to come.
We're not done yet. Ben, great to see you this morning. Thank you very much indeed for coming to see us here at Bloomberg. Ben Pott, Head of Government Affairs, joining us from the Next Group.